Hello, bachcho! Welcome back. I know. Exams are just around the corner, right? And today, we're going to tackle a chapter that, well, let's just say it can be a little tricky. Financial statements. But don't you worry. I promise, by the end of this super short explainer, you'll feel like a total master at it.
So is this financial statements chapter giving you a little bit of tension? Hey, don't worry at all. It's actually one of the most important chapters for sure. But you know what? It's also one of the easiest, if you just get the basic logic. So for the next 5 minutes, just forget all your stress, okay? Let's become pros together. Come on.
All right, so let's just dive right in. The absolute simplest way to think about financial statements is to just imagine a report card for a business. Yep, that's it. Just like your school report card shows all your marks in different subjects, these statements, they show how well a company is performing, how much money it's making and how financially healthy it is.
So who actually wants to see this report card? Well, it turns out a lot of people. Think about it. The owners, of course, they want to see if their investment, their paisa, is growing. And the banks, they're definitely looking at it to decide if the business is strong enough to pay back a loan. The government needs it to calculate taxes, obviously. And hey, even the managers inside the company look at it to check how well they've done their job and figure out where the business can get even better.
Okay, now I need you to listen very carefully. I'm serious. If you can just understand this one simple rule, this entire chapter will be an absolute piece of cake for you. This is it. This is the golden rule, the secret trick to scoring full marks. It's all about the difference between capital and revenue items. That's it.
So what on earth is capital expenditure? Simple. Think of it like this. When you buy a new laptop or maybe a new mobile phone, you spend a pretty big amount of money just once, but you get to use it for many years, right? It's the exact same idea in a business. When a company buys a huge new machine or a building, that's a capital expenditure. The benefit from it is going to last for a long, long time.
And what about revenue expenditure? Well, this is the daily routine kharcha, the everyday expenses. Think about paying your monthly internet bill or the electricity bill. You pay it again and again, and the benefit gets used up really quickly, right? Usually within a month or maybe a year. For a business, this is stuff like paying salaries to employees or the rent for their office space.
Okay, so this is the crucial point, Butcho. Just look at this slide. Capital expenditure, it's a big one-time spend that actually increases your ability to earn money, like buying a brand new delivery truck. And since its benefit lasts for years, it goes on the balance sheet as an asset. But on the other hand, you have revenue expenditure. That's the repeating, short-term stuff that just maintains the business, like paying for the petrol for that same truck. And that goes into the trading and P&L account. Now listen, this comparison table, it's a super common exam question, so please pay close attention to this one. Great. See? You already know the golden rule. Now let's start preparing the first part of our business report card, the trading account. The goal here is really simple. We just want to find out what I like to call the factory profit, or what's officially known as gross profit. Basically, it's the profit a business makes just from buying and selling its stuff.
Now, this here is the exact format from your textbook, so it should look really familiar. Just look at the top section. See that? That's the trading account. On one side, you've got your sales. And on the other side, we list all the costs that are directly related to making those sales. So how do we actually calculate this factory profit? It's a super simple 3-step process. Ready? Step 1. Start with your total sales and take out any goods that customers returned. That gives you net sales. Step 2. Subtract the cost of goods sold. And step 3. Bingo! Whatever is left over is your gross profit. Easy peasy.
Now, you're probably asking, Sir, what costs are included? Well, we include all the direct expenses, and these are just the costs that are directly connected with buying or making the goods. So think of things like the wages you pay to the factory workers who are actually making the products, or a term you'll see a lot, carriage inwards. Don't let that scare you. It's just the transportation costs to bring the raw materials into your factory.
Fantastic. So we found the factory profit. But hold on, is that the Asli profit of the business? Not yet. We still need to subtract all the other expenses, like office rent and advertising. So let's move on to the second part, the profit and loss account, to find the final net profit.
Okay, let's go back to that same format again. Do you see how the gross profit from the top part is brought down to the bottom part? That right there, that's our starting point for this section. And from this amount, we're going to subtract all the indirect expenses, basically all the costs of running the office and selling the products, not actually making them.
So, calculating the Asli profit is also super easy. Here's how we do it. We start with that gross profit we just found.
Then we add in any other little bits of income the business might have. And finally, we subtract all the indirect expenses, things like office salaries, electricity bills, marketing costs, you name it. And what we're left with at the very end? That's the net profit. This is the real earning of the business.
All right, so we've seen the profit. You could say we've seen the marks of the business. Now for the final part of the report card, the balance sheet. And I love to call this a business selfie. Why a selfie? Well, because it's a snapshot. It captures the financial position of the business at one single moment in time, on one particular day. Click.
So what does this selfie look like? It's really simple, actually. It has two sides. On one side, you list everything the business owns. These are its assets. You know, things like cash, machines, buildings. And on the other side, you list everything it owes to other people. These are its liabilities, like bank loans or money it has to pay to its suppliers. And here's the magic trick. Both sides must always be equal. They have to balance out perfectly. And how can we be sure they'll balance? Well, it's because of this one magic formula that you have to remember. It's the accounting equation. Everything a business owns, its assets, must be equal to what it owes to outsiders, the liabilities, plus what it owes to its owner, which is the capital. This is the ultimate check. If your balance sheet totals match at the end, you've nailed it. You can give yourself a pat on the back.
Wow, you have been listening so well. So, I think it's time for a quick test. What do you say? This is a proper PACA exam-style question. Now, it might seem a little tricky at first, but after everything we've talked about, I know you can solve it. You ready? Let's do this.
Okay, here's the question. A company spends a whopping 50 lakh rupees on a huge advertising campaign for a new product. Just imagine a massive promotion for a new movie or the launch of a new phone. Now, is this expense a revenue expenditure or is it a capital expenditure? Go back to our golden rule. Think about it. Does the benefit of this ad campaign last for more than 1 year? Okay, before I tell you the answer, let's do a lightning-fast recap. You ready? Let's go. Trading account gives you gross profit, our factory profit. P&L account gives you net profit, the Asli profit. The balance sheet is a selfie of assets and liabilities. And the golden rule is all about long-term versus short-term benefit. Got it? Good.
And the answer is, it's a special case. I know, a bit of a trick question. It's called deferred revenue expenditure. See, normally advertising is a revenue expense. But because a huge campaign like this one, 50 lakhs, is going to give benefits for more than just 1 year, it's not really fair to put that whole huge expense into just 1 year's accounts. So what we do is we treat it a little bit like a capital item, and we spread the cost out over a few years. I know, it's a tricky one, but now you know the logic behind it. See? You can even handle the advanced questions now. Brilliant.
And that's it. That's financial statements made super simple. You've totally got this, Bacho. Just remember our 3 main ideas: the business report card, our golden rule of capital versus revenue, and the business selfie. Just keep these simple ideas in your mind, and I promise you are going to do fantastically well in your exams. All the very best.